Okay, so what we're working on here is a new chapter, chapter 7. It's a shorter chapter. It only has 2 sections, but each section has some information that we want to go over. This first one's got a few pages. Um, it's not terribly in depth, but there's some thinking and some reasoning behind it, telling you why and why it's important that we have numbers to allow us to evaluate our business. So we've been working on that worksheet, and we had 2 columns at the end, the income statement and balance sheet. This first one's going to be talking about the income statement part of that worksheet, and so and how we can look at it and the reasons behind why you would look at it. So to prepare an income statement and analyze it, we're going to talk about just a couple ratios, which is basically dividing things by sales. Okay. Um, First, reporting financial information, and I gotta get these accounting concept sheets to you again just to double check that you all have them. And I should have done that last chapter. Um, so there's some accounting information, those accounting concepts in this that will help us kind of understand why, but you don't have to have them memorized. All right. So when we're reporting financial information, using the general ledger is kind of hard because it's very detailed. But every time you post something, at times that would be hard to just go through all those ledgers. So what we want to do is take that information and summarize it. And that's what we kind of used as the worksheet as a planning tool. And now we want to get a little more in depth and take that stuff and put it into financial statements. And so how we do that is we first are going to be talking about 2 different types of accounting, the financial accounting and managerial accounting. Okay. When you're looking at financial accounting, it's talking about reporting and the information. You have the taxes, you have different forms, you have shareholders, if you're a corporation, different things. So financial reporting is just worried about, financial accounting is worried about the reporting of the information to external users, to outsiders, to show how the company is doing. Or managerial accounting is focusing more on how we're going to report and use this information to become, the managers, the officers, the department heads to do a little better job. Okay. And so what we're trying to do is set these financial statements up. All right. Financial information needs to be reported, and good decisions are going to be made off of these financial statements, these financial information that we have. So we have a couple things we're going to be working on. Income statement and the ratios. All right. They give us a couple examples. If a business both had rent and utilities expenses, but reports only the rent expenses, they don't have all the information. So this accounting concept, full disclosure or adequate disclosure, is applied when financial statements contain all necessary information. And hopefully that makes sense. Excuse me. That you're fully disclosing all your expenses. You don't want to hide expenses or forget expenses because the managers can't do their job. These external users that we're talking about and internal users up here don't have all the information. They're Delgado, our company, from this chapter next, then we'll get a new one on chapter 9. Delgado's prepares 3 financial statements: an income statement, which we're doing today, and then a statement of owner's equity and balance sheet. Okay. We have talked about income statement in the column on the worksheet. The balance sheet, statement of owner's equity, is something that's newer. Okay, a financial statement that reports changes in that capital account for proprietorship for a period of time is owner's equity. So when we're talking capital account, we're talking capital and drawing. But as your company, your Delgado, what else do you get to count in the statement of stockholders' equity? Is not just capital and drawing, but it'll also be the net income or net loss that we approve, that we figure and find out throughout the year. All right, we always try to do this. We do this at the end of the fiscal period, the end of the fiscal year. That's the accounting period cycle. When we start businesses, it's expected that the business will continue indefinitely, so we keep these financial statements. And when you set up an LLC or a company, you'll have to have rules and regulations about that. But the idea of the going concern is that financial statements are prepared with the expectation. These 3 financial statements are being prepared with the expectation that we're going to continue working. We're not like, okay, it's over after this year. We're constantly thinking and creating these documents with the intent that we're moving forward every time. we don't usually do a lot of ethics, but sections just to save us some time. But stakeholders is something you'll see later, and basically what stakeholders is talking about, and it's a business law thing. It's a maybe a church thing. The utilitarian theory states that the ethical action provides the greatest balance of good over harm. We used to call it the greater good, right? What do you make a decision based on who can be helped, how many, the most people that can be helped, the greatest good. And when you're making business decisions, you want to make sure you understand that the people and groups affected are going to be some stakeholders involved in your business decisions. To cut expenses, if you cut employees, those are stakeholders. You know, you might have customers when you raise prices; those are stakeholders, and they talk about major stakeholders, includes employees, customers, local community. So any groups are people that are affected by actions of our business or stakeholders. You might see that on the study guide. All right, so this is our worksheet. We have the income statement section. Okay, this should not look different than, this is very similar to what you've seen in the past. We have all our expenses. We have our revenue. Okay, we're trying to always, the revenue earned and expenses earned to make that revenue are reported in the same fiscal period. We're always matching expenses with revenue. So the income statement shows our revenue and our expenses. Okay, and this is going to be over a specific period of time. We're trying to show if we have net income or net loss. Are we operating under the assumption that we're making more money than we're spending, that kind of thing. So that's what we're talking about here. Where are we getting these information when you're trying to talk about an income statement, preparing the income statement from a worksheet? Delgado gets this place from two places. Okay, the account titles and from the worksheet's account title column, and the account balances from the worksheet's income statement. And that's what they're saying here. Where do you get the information for an income statement? From the worksheet account titles and the income statement columns of the worksheet. Okay, the worksheet, then we take that information and put it into an income statement, and the income statement has 4 sections. The heading, who, what, when. We have a revenue section, which is sales. We have an expenses section, and then we have a net income section. Okay, so when you get a true-false question or a test question that says the income statement gets its information from the general ledger, well, that's false. We get it from our worksheet, okay, the account titles, and the income statement sections of the worksheet. And that's what they're talking about there. Again, we don't do a lot with these things, but they're talking about budget, deficit, surplus. There's some financial things here. You do a lot of this in money management. We don't talk a lot about budget, so to speak, in our clouding class. We're talking about you need to make more money than you spend, so we need to keep track of our revenue, we need to keep track of our expenses, those types of things. But these are some things you might see later too, so we want to touch on. The budget's a financial roadmap, obviously, that we're talking about when we're looking at spending versus how much money you have, or how much you're saving, how much money you're earning. Okay, and so it's the businesses must individually evaluate their financial condition. The first step in doing so is to create a budget, figure out how much income you have, how many expenses can you be thinking about. There's certain expenses that will be fixed, like your mortgage or your rent or your car payment or your school loan, stuff like that. Obligations make the same every period. Okay, there's also different expenses that they call variable expenses. So these fixed expenses remain the same every period. We have variable expenses that change from month to month. That could be gas, or that could be you're going out to eat money, or whatever the case may be. And what budget people will tell you is you need to have a spot, the pay yourself first strategy, which means you would include and invest in the fixed expense. So you would include savings as a way of an expense kind of in your brain. So, for example, teachers get paid once a month. I take money out of my check every month, and it goes into an account. All right, I don't even get that money. I don't get that money and then decide to put it into account. It just goes into the account. I take it out so that I don't have to do it. It's like just part of my expenses, even though it's going into a savings, a fund for me. So that's kind of what you're talking about. You need, most financial advisors will say at least 10%, if not more, You just got to see how much money you're making. Obviously, the older you get, the more you can put away. Positive, positive balance towards expenses is going to be a surplus when you're looking at revenue over expenses. If you have a surplus, that means you have more money coming in than going out. A surplus can be saved for future, needs such as, infrastructure, transportation. If you need new trucks or computers or a new register or something for your business, you can use that and save up. So surplus is a good thing. A negative balance after you get revenue and expenses is going to be called a deficit. All right, that when you see this deficit, then you need to figure out how you can control your expenses or raise your revenue. These are just some examples. But I wanted to make sure surplus means you have more money coming in, deficit means you have more expenses. Okay, the budget's just this idea of organizing your spending and your saving and your expenses. If you ever see the pay first strategy, that means you're putting in a savings part into your fixed expenses. I'm always going to take $50 out, $100 out, $500 out, whatever your step may, whatever you are in the process. We don't usually spend some time on those sections, but they're you'll see them later. All right, so we got 4 parts to the income statement. We said first we have the heading, who, what, when, Delgado income statement, 4 month ended still. I'm still highlighting that because the balance sheet's just a little different. So don't forget the heading, just like we talked about on the worksheet, who, what, when, okay? You're taking the information, and this looks an awful lot like the worksheet. You'll have the who, what, when up top, but then you'll have a revenue section. That's the second part of the income statement. First part we said was heading. Second part was revenue, which we list sales underneath it. Third part is expenses, which we list in alphabetical order from the worksheet, which we got from the general ledger, but we get them all down. We have our adjustments included with insurance expense and supplies expense. So the third section is expenses. We add them and put them the total in the far right column. So we have revenue in the right column. Now we add expenses into the total into the right column. And then the fourth part of the income statement is net income, subtracting sales from expenses. This is step by step. You can go through it. We're not going to read it. This is just showing you how you come up with the net income. You've already done that on the worksheet. This is just a quick reminder. You subtract revenue from expenses. Obviously, if expenses was bigger, this would be a loss. And you put it in parentheses. It would be a net loss. But here, this revenue is bigger. So the income statement's kind of, to be honest, you're just kind of transferring information, putting it into a form, adding a couple headings, but very similar to what you did on the worksheet. So here's a finished copy of it. The first part, who, what, when. The second part's revenue. The third part is expenses. The fourth part is income. But now we have this column over here called percentage of sales, and that's what we're talking about with analyzing the income statement. Okay, so this percentage of sales. When we're managers, they might have component percentages. We used to call them component percentages. They call them financial ratios or financial ratio analysis. Basically, in the income statement for this service business, the revenue reported on the income statement is compared to 2 items, total expenses and net income. So we're comparing our revenue, sales, which we're going to have 100% because we're going to divide sales by sales. 1 divided by 1 is 1, right? But then we're going to divide total expenses by sales to get a number, a component percentage. We'll round to the nearest tenth. Then we'll take net income divided by sales. And then there's industry standards that we can compare it to last year's, last quarter's, last month's, previous years, what we've done, or previous years of what businesses have done and how they've trended in certain directions. So 45.7 might be good or bad depending on what you've done in the past and what your similar businesses of similar size and things like that. Okay, and we'll talk about it a little bit more. But a comparison between 2 financial components is going to be financial ratio. When I think ratio, I think dividing. Calculating and interpreting financial ratio is called ratio analysis. We used to call it financial ratio analysis, component percentages. These things are all very synonyms. They're very similar. Okay. When you're looking at this and reporting this information, this is going to be called vertical analysis when you're taking information from a financial statement and a percentage, that's what we're talking about. Reporting an amount of financial statement as a percentage of another item in the financial statement is called vertical analysis. The calculation, interpretation of financial ratios, ratio analysis. Does it matter right now? No. You get to use your books. I mean, to have these memorized is not necessary. But reporting an amount on a financial statement as a percentage of another item is going to be vertical analysis. The calculation and interpretation of this financial ratio is ratio analysis. It seems like we're splitting hairs, and that's okay, just as long as you got that written down or highlighted so you can find it again. You get the idea that we're going to be taking financial information and then dividing by a certain component. For this, we're dividing by revenue or sales. That is going to give us our component percentages. They show you how to do the ratios by dividing by sales, rounding to the nearest tenth. I might have went too fast. Yeah, expenses are more than revenue. It's a net loss. So Mr. Delgado knows what his acceptable levels are when looking at previous fiscal period or organizations' industry standards. He finds out that acceptable total expense ratio is not more than 48. They kind of word it tricky, so I wanted to make sure we talked about it. Not more than 48. Well, his total expense ratio is 45, so that's acceptable. Now, maybe it's higher than it was last month, and he might want to try to figure out why. Or maybe that's the lowest it's ever been. He wants to go, geez, why do we have such lower expenses? Some months are going to be different. Some businesses are a little more busy, different seasons, whatever the case may be. But this would be what you'd be looking at the total expense ratio, is trying to see the industry standards and what is acceptable or not acceptable, and that's what we're talking about there. For the net income ratio, for Delgado, again, looking at the industry standards, previous fiscal periods and years, he found the acceptable net ratio is not less than 52. So it has to be greater than. I don't know why we don't just say it has to be greater than, but not less than 52. So with his ratio of 54.3, it is greater than 52 and acceptable. Okay, the ratio of net income to total sales is called the return on sales, the ROS ratio. Again, memorizing it might not be necessary. You'll have to be able to use it. And you should be able to by dividing by sales. That's where we get these numbers, and they're showing you down here. Okay, both of them are divided by sales. Then they'll give you a percentage. Hopefully it's acceptable. If it's not, then you gotta say why. Think like an accountant. There's nothing on there. Income statement with two sources of revenue. Let's say we have two. Repair It Now as a company, let's say, that has sales from riding lawnmowers, sales from push mowers. They want to keep track of both revenue streams. They will list them both on the income statement. Okay, so when you get this information, it says if you have a company that has two sources of revenue, you only list one. No, you'll list them both. Okay, you'll list both revenue strands. You'll list them on the left. You get the total revenue on the right. Okay, and then we have our expenses. It's just adding one more line, keeping these on the left, and then putting the total on the right. All right, so if you end up looking or needing to look at two revenue strand, make sure you go to this page. But yes, we will. The income statement is prepared, has both revenue accounts listed. Do you list both revenue accounts on the income statement? Yes. If total expenses exceed total revenue, a net loss is reported. Okay, our worksheet and test had a net income. Here's a net loss. Net losses are reported losses with on financial statements, often with parentheses around them, so show that that is a negative number or a loss. And we remind you here, an amount written in parentheses on a financial statement indicates a negative number. Okay, this is just to show you, can you put two revenue strands on there? Yes. Should you? Yes. On the income statement? Yes. That's what we're doing. That should be it.